Hey guys, welcome back. It's Marty with Options Unleashed. Today's video is our educational series on best practices. Today's video is position sizing. We're going to talk about position size in this video, probability, what buying power is all about, portfolio allocation, and I'm going to show you a calculator that I created, a quick, easy calculator that you can use or we can review in the video, and then other factors to consider when you're using position size. So what is position sizing? Position size refers to the dollar amount that an investor trades for an investment relative to their overall portfolio value. In this case, in most cases, we don't consider the margin account. We just consider the actual raw dollar amount. So for example, if you have $25,000 in your brokerage account, we would consider that your value. If you have a margin up to 100% of that or 50% of that value, we wouldn't consider that value in determining overall position sizing. So understanding the effects of position size on your portfolio is probably the most important factor in being a successful investor, at least for option trading. And again, this could be considered if you're doing long portfolio trading. You might consider like a diversified portfolio with just a few stocks or many stocks. But the point here is that position size in an option portfolio is similar in that you don't want to allocate too much to any one particular trade and any given expiration relative to that overall position. And that's probably the single most important factor that option traders use in their best practices. It's also the number one factor that people cite when they're explaining why they had any bad given year, or why they blew up a trade or blew up their account, is usually because they got too big in their position. The second most important factor that I would consider is cash. And the reason for that is because you always need some amount of cash, or actually a lot of cash available, up to 50% in most cases, so that you can balance your portfolio when the market goes against you. So best practices: keep your position size for each trade in the range of, let's say, between 1 and 5% of your portfolio. Now, the upper and lower range can vary by your style of trading, and you'll hear this a lot out there. People won't tell you necessarily why you want to do that. We're going to go into a little bit of why you'd want to do between 1 and 5% and why we choose those numbers, and then also some examples we're going to give you. So while there's other videos out there that will explain position size, for me, it didn't really sink in until I really started researching it and doing it in practice. But what I want to help you guys with is try to go over these best practices, position size being the first and foremost, again, most important thing, but also give you examples so that you're not left scratching your head like I was in determining, like, okay, I get why it's important, I see it, but it doesn't really sink in until you really start looking into some of the examples. And that's what we're going to try to go into today. And again, it varies by your style of trading. Typically, the probability of profit that you're looking to achieve on each trade, the market conditions, the implied volatility, and the overall delta of your open trades. We're going to get into all of those today. Now, keep in mind, position size and buying power are not necessarily the same thing. We'll review how you can avoid over allocating some of your positions. So in general, it's a good practice to stay small, let's say 1% to 3%, and then scale to 5% for some trades having high probability of profit. Now, note, actual losses on a trade can be larger than intended when taking into consideration the actual events. So for example, your position size will have a buying power reduction associated with that. Buying power reduction is what we're going to go over, so that you kind of have a handle on why we use buying power reduction together with determining position size, and also trying to figure out how many trades you can allocate on any given portfolio. And that's why we want to go over the calculator as well, so that you have a really good handle on not only what your position size should be, but how do you put it all together with multiple active trades that you have open, with other types of trading styles that you have in your option allocation, and then and how that has an overall effect on your portfolio so that you don't get in trouble. So what is the best practice? Option trading is based on high probability and number of occurrences, right? So the smaller the position size and the greater number of occurrences will closely match your risk level over time. So if you have a high tolerance or a high risk tolerance, then your position size can be bigger, but note that your losses could be considerably bigger. And again, the actual losses from a trade might be actually bigger. If you have a low risk tolerance, then you would have smaller occurrences, smaller trades, a higher probability of profit, greater number of trades, and you'll have more consistent profit. So over time, either strategy will reflect your risk tolerance. And so it's only kind of up to you to decide that risk tolerance, but you just have to keep that in mind, that the smaller number of trades, the more occurrences over time will kind of converge, if you will, and closely match your risk level over time. So let's look at a typical chart that people show when they talk about position size for option trading. So on the left-hand side is potentially the size of your portfolio. And because we want to make this video available for people with small accounts all the way up to large accounts. You have portfolio ranges here between 5,000 and 250,000. I'll pick something in the middle, about 50,000 here in bold. And then what we do on the top is we say on any given type of percent that you want to have as a risk level between 1 and 3%, let's say, and 3% we'll target as like a good middle ground. Then you can kind of go use the chart below to say for a given portfolio size, let's say $50,000, and you want to have a 3% risk level for your position size, or not risk level, but you want to use a 3% on average best practice. That means that you can allocate $1,500 per trade in your option account. And now that's kind of like pretty straightforward, but it just gives you a good rule of thumb in terms of where you can start. So let's just say, for example, that some of your trades that you're starting out with, if you're doing shorting, if you're doing naked short puts or naked selling calls, and you're finding out that your option buying power reduction is greater than that $1,500 for a $50,000 portfolio, then you're going what we call too big. If your trades, your buying power reduction, if you're using spreads, your buying power reduction is going to be on the lower level. It's going to be down in the 1%, hopefully, or even lower if you're doing spreads. But then again, your probability of profit will be higher. Your risk will be lower with using spreads, but your overall profit, right, will be lower. But that's okay, because again, we're looking for number of occurrences. We're looking to lower our risk. This chart here helps you in terms of your overall risk level. So that says that you're risking at any one time 3% of your overall portfolio towards a bad trade. And again, so why do we pick these numbers? Why do we pick between 1 and 3%? And again, it goes back to probability. So now we're going to get into a little bit of probability discussion, as well as in the business we talk about option trading in terms of using standard deviation, right? So we know that stock prices, or at least option prices, tend to model more like Gaussian or normal distributions over time. And this chart right here basically says that for any given probability level that you're looking to target, let's just start with a 50% level, 50%. So this 50% level, the first one, would be kind of equivalent to flipping a coin, heads or tails. If you have a 50% chance of flipping a coin, then you have a 1 out of 2 chance of being wrong, let's say. So if you flip the coin once and you pick tails and it comes up head, you had a 50% chance, a 1 in 2 chance of being incorrect on that coin toss. If you toss the coin 2 times, and let's say you chose, each time you chose a given outcome, you would have a 1 in 4 chance of being wrong. And if you flip that coin 5 times, you would have a 1 in 32 chance of being wrong, all 5 occurrences. So what we look at with option trading is, this is just a basic probability chart. This chart in itself has nothing to do with option trading, but what we can do is, because we're option traders and because we're not trading stock, like a day trader has a 50% chance on any given day that a stock will go up or down. So a day trader would be in this 50% camp right here, but they would be doing it all day long, and they would be taking a much larger risk. This would also be the equivalent of trading a stock on any given day. On any given day, a stock can go up or down. You have a 50% chance that it's going to go up or 50% chance that it's going to go down, all things equal. We can pick a probability level associated with the option based on the option price. So if I want to sell a out of the money put option, if I target the 70% level, which would be inside that 1 standard deviation, but if I target my option trades at 70%, then I have a 1 in 4 chance of being wrong, and then 2 times I have a 1 in 11 chance of being wrong, and so the odds go dramatically up in your favor. So that means, after 5 times, or after 10 times, after 10 occurrences, let's say of 10 option trades of being 70% probability of profit, you would have a 1 in 669,000 chance of being wrong, which is significantly less, right, than 10 times at a 50% chance. These numbers go up extremely high, so your chances of failing 10 times in a row are extremely low. And that's why over time your probability level of success would be 70%. You're trying to achieve that with your option trading. I know that chart was a little bit hard. It was hard for me the first time, but it's extremely important to understand why we pick 1 standard deviation moves and on how that relates to probability and probability of success. Let me go back to that screen one more time too, and as well explain standard deviation. I don't have a slide right here, but maybe later we'll come up with that slide where 1 standard deviation move gives you that 68% of probability. So that's kind of why we target that 70% level on the chart here. And something to kind of note is, when we do place a single-sided trade, like a directional trade, if you're selling an out of the money put, you're probably targeting what we call that 84% chance of success. And the reason for that is because the stock can still be within that 1 standard deviation move, which is 68%. So 32% up to the positive and 33% chance of going lower. But because you're choosing one side of that trade, you really are targeting an 84% chance of success because of the tail risk that's out on the right-hand side of the curve or the left-hand side of the curve, wherever you are. You have to kind of make sure that you're targeting that what we call 84 or 85% chance of success on that option trade, but it's still within what's called a 1 standard deviation. If you're targeting 2 standard deviations, you would have to get out to that 95% level of out of the money if you wanted to sell that put. And that would put you down in this level. That would put you at the 80% or 90% probability level. It would probably be closer to the 80% on this chart. That means that in a one, and if you're doing that 10 times, if you're selling 2 standard deviation moves 10 times in a row, you have a 1 in 9.7 million chance. 1 in 9.7 million chance in being wrong all 10 times. Okay, so let's look at an example of a 100,000 portfolio, $100,000 in cash, 50% towards stock and 50% towards options. Now, for the option trading side would be this entire left-hand side. We would see that we can break that down into an option allocation strategy. And again, everyone has different strategies, but this kind of closely resembles what I do in my strategy. I have an option selling put strategy where I allocate about 16% of the portfolio towards selling put premium. That's kind of like you're trading for income. You're trading your larger indexes, your larger safe beta names where you have very low risk of a stock moving on big news or events or headline risk, things like that. These are your plays where you are really betting that the stock will stay where it is, go down a little, but mostly kind of continue to gradually grind higher. So that's your selling put strategy. And again, this isn't a video on selling puts, but we would typically sell our 84% out of the money, or maybe like a 30 delta, 25 to 30 delta puts. And then we would be selling those or closing those, buying them back at about 50% return on profit. So you take your 30 delta and try to close those out within a certain time frame. About, if it's 35 to 40 days, we'd be looking for like at that. A lot of experts tend to think the 21-day mark or around there, where you're kind of avoiding any real gamma risk, if you will, or theta decay accelerating. You're still able to roll the trade and get out and get into another month. If you had to roll out or roll out and down, you can do that. And if you do have a profit, you're locking in 50% of that profit early, and you're basically freeing up that buying power to use for another trade. Again, we're trying to do high occurrence trading, high frequently high occurring trades with a high probability of profit, taking those profits early and then reusing that capital for new trades. The other allocation strategy here, so that was the purple. The next one is in red, which would be kind of like collecting your credit spreads. You would sell credit spreads, sell bull put credit spreads, or sell call spreads, sell iron condors. This would be also your strangle strategies. You're selling, either just you're selling calls or selling puts, but you're also making, strangles or iron condors. This would be your high IV strategy stock. So anything that has like earnings events, anything where your high IV is greater than your implied volatility is greater than 60%. And again, we try to go between 30 and 45 days for these trades as well. But these are more of your earnings trades and spreads. And then another 4%, I would say in here, so that would be about $4,000 or 4% of your account. And what I consider low IV, you're buying, again, depending on the market conditions, but if you're targeting a certain event and you want to commit some of your portfolio or cash to low buying strategies, that's something that can generate a lot of big wins sometimes for you. These aren't high probability trades, but they're low probability trades, but they have high probability of profit. With high risk and high reward. So these would be your unbalanced call butterflies, all unbalanced put butterflies, just put call butterflies together, or just buying outright options. Or even if you bought back a short call if you bought back a short call or a short put, and now you left your long call or put on, that would be somewhat considered in this category, but not really. These would be just, I anticipate event in the future. I want to be part of the trade, but I don't have any option strategies right now in terms of selling premium, but I really want to be part of this move up before a particular event. You might be inclined to use like a call fly strategy in that case if you anticipate the stock moving up, or a put fly strategy moving down. And we'll go over a whole video on call put butterflies and unbalanced call and put butterflies. And then cash is the big one, right? So cash should be about equal to your other option high implied volatility strategies. So you need lots of cash just in case you need to adjust trades. So cash is king. The beauty about the option portfolio is having enough cash on hand so that when the market does go against you, you can take advantage of that volatility. Whether it's a news events, or we've had a bad bloody bloodbath in the market, or we've had some kind of negative event, and you want to take advantage of that volatility. It could be an earnings volatility, it could be a mispricing opportunity. You want to have that cash available to apply that cash to other areas in here. And then there's one left category here because we all like to chase things and sometimes buy premium and what I call flyers. So where you're chasing a stock, or you want to be in on the latest EV stock or something for the weekend or over the weekend, and you want to just outright buy some calls. I allocate here about 0.5% of your portfolio, which is less. It's about 1% overall of your options account. So it's that 1% again that we call 1% of your position size for your option account, just in flyers. So you can have, if you want to have a trade on, and you're not going to do this every month, but allocate $500 towards that flyer that you wanted to have on there. And again, this is all relative to how you are feeling with your overall portfolio. If you're having a great month, you might want to have a flyer. If you're not having a great month, look to the other high probability strategies where you can kind of keep your portfolio in check. Let's talk about now option buying power reduction. So if you're short put calls, depending on your brokerage, typically a brokerage will take the underlying price, and they'll take about 20%, considered about a 20% buying power reduction. So that would be 20% of the particular trade. And we'll go through an example in a minute on Apple, but a typical how to calculate your buying power reduction for a short put or short call, you would take 20% of that trade times 100, and then minus the difference of the underlying and the strike price. So in that case, if you're selling a put that's out of the money, you're going to get back, you're going to get 20% of that price, but you're going to also reduce that, right, by the difference of the underlying and the strike you pick times 100, and that would be considered your buying power reduction. So if an example, let's say a stock is selling at $215, right? And you want to sell the 210 put. You would take 215 times 0.2 or 20% times 100 would give you $4,300, minus the difference in the strike price and the underlying, which would be the 215 minus the 210, equals the 5 times 100 equals 500. So your buying power initially reduction is 4,300. It gets reduced because you're selling an out of the money put, which has a higher probability profit in the brokerage house. We'll give you credit for that. So you're reducing your buying power a little bit here, and it's now a total of $3,800 buying power reduction. So this is the buying power reduction that we want to use for our position sizing. And again, buying power reduction isn't always the same as position sizing. But because of this strategy, now you would determine whether or not, if you're selling this $215 stock price and you realize that $3,800 is over or bigger than your position size that you're comfortable with for a particular trade, then you know that you have to pick a stock that's selling less than $215, or because on average it's going to be 20% of that, or you would need to sell that put further out of the money to account for a bigger reduction in buying power that you need. So you might have to go to 2 standard deviation move, which would give you a less of a total overall buying power. And then there's other strategies. You can also just choose to sell a put spread in that case, which is dramatically less. We'll talk about that in a second here. So the next example would be on the short spreads. And the short spreads are a lot easier. You would take the width of the spread, and I never really understood this, the width of the spread. When we say width of the spread, we don't mean the width in terms of an iron condor. We mean the width of the vertical spreads that you're taking. So for example, if you're selling the 200-210 short put spread, the width would just be the difference in these two strikes. It would be $10 wide, we say. And let's say you're selling that for a $2.30 credit. You would take the $10 times 100 equals $1,000, and then you're actually going to subtract from that the credit that you received, in this case $230. So that would give you an overall buying reduction of $768 for that credit spread. So notice that this is a $768 buying power reduction. And from the previous example, we had a $3,800 buying power reduction for selling that 210 put. In this case, it's the same 210 put, but we're buying the 200 put for protection. The brokerage house is going to give you credit for that protection that you have on. And this calculation, simply the width of the strikes minus the credit received for the trade, would give you that much reduced buying power reduction, which would be only $768 for this trade versus the $3,800 for buying power reduction in the other trade. So notice for spreads, if you notice that it's dramatically reduced buying power reduction, it's remarkably less, and then notice that this will be typically below. And this is for one contract, but typically this will be below your position size that you have on for any given portfolio. So if you have a low to moderate size portfolio, and your position size is around that $1,500 per trade that we talked about, then you could probably do 2 of these comfortably for that one particular trade. And then long spreads, basically, the long spreads are basically the debit you paid. So let's say that you are paying a price of $4 for the long put minus the 160 short put. That would give you a $2.40 cost of the trade. So long spreads are much easier even to calculate. Okay, so here we have the options. My option allocation calculator that I created out in Google Sheets. And what up in here, I had an example where I have a $100,000 portfolio. I want a 50% stock allocation. And then for all the other categories in here, strategies, I had a put strategy allocation of 0.33 or 33%, 33% of that towards high IV that I wanted to allocate. And then almost a 1% in low IV, and then cash, 25% cash, and a 1% flyer of the option section. So let's play around. Let's say you have a $25,000 portfolio. So I can type in $25,000. And let's say that I'm a little bit more aggressive in options because my total portfolio is because it's a lower size portfolio, and I want to get into the options market, and I have a separate, let's say you have a separate stock option account. Let's say that my stock allocation in this case is going to be 0. So we're going to focus purely on an option allocation strategy, and that's easy to do by putting in 0 here. So now my option allocation is 100%. My put strategy is still 33%. My high IV is still 33%. Low IV is almost 1%, cash, a 25% on cash, and my flyers is a 1%. So that gives me 100% over here on the right. That just tells us that we're entering the right numbers. So this tells us and we start with the purple, that the option selling put premium says that we can sell up to $8,000 of our portfolio. We're going to consider for selling put strategies. And then this tells you that our option position size at 3% of our trade is going to be about $750. And this tells us on average that we're going to have about 6 trades on any given strategy. So what this calculation does here is it tries to take the average of the selling the put strategy, high IV and low IV, and it kind of comes up with a rounds up an average. So this tells us that we want to we can allocate 6 trades up to $750 of buying power reduction for each of these strategies, and it would be pretty much a safe trade. Then the flyers would still be on their own at 200. You wouldn't want to go above $250 for this strategy, but you can go up to $750 for a 3% position, which is fairly high. But again, because we're allocating that 3% towards selling puts and high IV, if you are using that 70% or one standard deviation move, and if you're selling puts at that 84% out of the money chance of being out of the money, then you're doing good. You're doing good in that area. If you're selling, and also if the IV is greater than, if the implied volatility, not the IV rank, but if the implied volatility for that particular option expiration is greater than 60%, then you have a fairly good chance of using the best practices in option trading. So let's just take a look at an example, because when I started too, there was a lot of theory on options, and it was very hard for me to even understand. I needed to see like a real example. So let's bring up our TOS platform. I have Apple in front of me. Apple actually has earnings next week. So let's say you want to sell put premium in Apple next week. We have earnings coming up on the 27th. That's next week. And Apple is a good candidate for earnings. We're coming out of the reopen and the pull forward, the COVID trade, and we want to target selling put premium on Apple for earnings. We would look at our Thinkorswim platform, and again, depending on what platform you're looking at the various expiration dates. And in this case, because earnings is on the 27th, we need to go to that next. This would be the January 29th. So this includes earnings, which I already have a trade on. But let's just say for this video, we want to target that 29th of January, and let's look to the right at the implied volatility. So the implied volatility over here in these columns is kind of the average implied volatility of option premium for that particular expiration month. So in this case, because earnings are coming, you can see that the implied volatility is creeping up. You can also see it on the chart. Down here, we have a graph of implied volatility that you can put on your platform. So you can see it rising over the past couple months. And if you go back to the Analyze tab, you can see that we have a 62%. So greater than 60% is what we're looking for typically. And it's next week. So we can scroll down and we can look at our calls, right? This is our call chain and our put chain. And we can target the selling a put. And what Thinkorswim and other platforms do is they allow you to select what type of view you want to see here. And for option traders, we typically select the implied volatility, the probability, and the delta, which are good to look at. And if you want to look at that probability of out of the money of about that 83% range, that gives you that one standard deviation of being out of the money. So 83% out of the money. I want to sell that premium, right? So I'm selling to people that think Apple is going to be below um, the strike price 129 on earnings. And I would target this, I would put this date up here. I would set this date to 130. So the TOS platform will give me that gray shaded area of where the one standard deviation move is. And then I can say set slices to charts, break even on 130. And this tells me I have a 91.45% of it being out of the money by next Friday. Just to show you how to calculate the buying power reduction, the stock price is 139.07. So we could bring up our calculator. The platform would do it automatically. But I want to show you guys how to do it by hand if you wanted to do it by yourself. So you would take the $139, let's say we just round it, and we would take 20%, the brokerage house would want to take 20% of that. So that, and then you multiply that by 100 and you get 27.80 for the actual buying power reduction. But they're going to give you a credit. The credit they're going to give you is the fact that this, you're going to sell the one, you're not selling the at the money 140, you're selling the 129. So they're going to give you a credit in this case. If we go 140 minus the 129, they're going to give you that $11 in credit because it's got a higher probability of being in the money. Or a lower probability of being in the money, a higher probability of staying out of the money, right? So that means they're going to give you the 11 times 100, which is going to be $1,100 credit back towards that buying power reduction. So if we took the 139 times 100, 139 times 0.2 times 100, and then we took back 1,100 of that, that would give you a $1,600 buying power reduction for that trade. So going back to our chart, if your position size is $1,600, then that would be a good trade for you to be able to take because you want to stay below your position size. Now, if we wanted to allocate an option strategy towards this and we wanted to make this more of a strangle, we would just add another leg to this option. We would target the 84% trade, 84% being out of the money for a call, which would be approximately the 152.5 or even the 150 strike price. So if I sold that 150, let's say, strike, or I gave it a little more because Apple I might have a little bias in the background that I think Apple is going to have a blowout quarter. I might actually go all the way up to the 160, selling that, what would we call? We would call it'd be an 8 delta here, but I would sell that 160 call to make this now a strangle trade. So the strangle is where you're just selling that out of the money put and you're selling the out of money call, and you're kind of selling a naked put and a naked call, and you're targeting next week, and now you're collecting a little bit more. You're collecting $1.30 on the trade. It would be the sum of 84 and 46 cents. You're collecting about $1.30 on the trade. And if I look at the if I set slices to break even on 130, that's a 90% chance of success for next week. And then your buying power reduction will be probably double what you had before. So you have to take that into consideration when you're placing that trade on. So hopefully this gives you a little bit of an idea on how you can take how you can calculate buying power reduction quickly for based on your position size. So now let's say this $1,600 buying power reduction is too big for my account, but I still wanted to be in this trade. Another thing you can do is you can take this, you sold that out of the money put, but because you don't have enough buying power if Apple has a bad, let's say Apple has a bad quarter and announces bad news and the stock gets pummeled, you're losing a lot of money here. You can cap those losses by buying kind of an insurance play, right? You can actually take that 129 and you can actually now buy insurance, or you can buy that lower strike, the 128, and in Thinkorswim you hold the control key down and you can click on the buy, and you can make this now into what's called a vertical spread. And a vertical spread, you're going to collect a lot less money, but your buying power reduction is going to be the buying power reduction calculation that we use for spreads, which is basically, again, just the difference in the strike price. In this case, it's $1, and then minus the credit you receive. So it's going to be $1 minus 15 cents, which is 85, and so it's an $85 buying power reduction. And because, let's say you're buying your position size now, again, different than buying power reduction. If your position size is, let's say, $1,000, you can actually crank this up to you can sell about more than 10 of these, right? You can target, I want to sell, if your buying power reduction is, if your position size is $1,000, you can sell 11 contracts for $935. It's inside of your position size, and you can collect $165. Next week, most likely after earnings, you can collect up to 50% of that, because as a rule, we sell at a 50% profit. But if Apple, really blows out the quarter and you're one directional on this side, on this case, you have a chance of actually collecting more than 50% on this trade. So the maximum you would collect would be $165, but you'd probably close this trade out for about half of that, or $80. And that's basically how we would calculate our buying power reduction, and just show you how we size our trades for that particular option strategy. So remember at the beginning we said that risk ranges can vary between 1 and 5% based on your style of trading, i.e. your probability of profit for each trade, your market conditions, your implied volatility, and overall delta of your trades. This is why cash is very important between the 20 and 50% at all times. We didn't go into this too much, but going back to the slide, remember we said that implied volatility has a lot to do with our position size and market conditions. What does that actually mean? Well, just as a general practice, general rule of thumb, what we want to do is the area shaded in green here, the 1 to 2%, is where you have a lower IV strategy and you have market conditions where the market conditions in your IV and your and how you're feeling on any given month of trading is not suited for selling premium. And so in this case, you want to be, your position size, you want it to be in the 1 to 2% range, because you still want to keep the number of occurrences up. But because the market isn't giving you high premium or a lot of extra premium and high volatility, and the market is kind of what we just call boring in this case, it's really hard for option traders to make money when there's not a lot of volatility. So in this case, you want to be in that 1 to 2% range when IV rank or IV is low in the market in general. And then what you can do is you can kind of crank that up on any given day or strategy or week to 4 to 5% when you got some really extremely good high IV, you've got mispricing in the marketplace, and you want to take advantage of that IV strategy. Because one of the things we kind of noticed is that the whole like reversion to the mean type of principle, where once IV rank, and I'll use kind of like how wide we go with the strikes, or how you can envision it this way, like how much volatility there is, but you can also look at it this way, how wide do you want to get. But if you look at volatility in terms of what we call volatility contraction, right? So when earnings happens, your volatility will go from a high IV, it'll collapse down to low IV in a period of a day, like after earnings. And the reason for that is because the event is known. So when things are unknown or we're anticipating an event, the volatility tends to rise. But what happens is when you have the event, you tend to get volatility contraction at a much more rapid pace. So option traders like to take advantage of that option contraction, or what we call volatility crush, and that's that vol crush that where we actually get paid. So because option traders are trying to collect premium rather quickly, we target that 30 to 45 days, which is where where the delta and the theta give you the most amount of contraction and kind of premium in the shortest amount of time. But when you actually get it, when you get that profit and you want to repeat that over and over again, that's why we take 50% of the profits, because to squeeze out that extra little bit at the end is kind of pointless, right? So for example, if you could collect $100 on a trade and you had to wait 30 days, would you rather take $50 in 7 days and then reuse all that capital to do another trade, or would you want to just wait the whole 30 days for the $100? Over time, it's much more efficient to take those high number of occurrences in a short period of time and then reuse that capital for new trades going forward. So, but in general, the reason why you can go bigger position size when high IV is high is because high IV begets low IV. So in other words, high IV will contract in general down to lower IV, and you're going to make, if you're selling premium, you're going to make money doing that, selling premium. You have a much better chance of it contracting than you do of it going higher. So that's why we like to target 60% implied volatility, because there's a much greater chance that a stock will go from 60% down to 30% where you're collecting than for it to go from 60% to 100%. There are times where the IV will go higher, but over the next 21 days, the chance that 60% volatility will go 100 and stay at 100 is very low, even with the VIX. If you look at spikes in the VIX, the spikes happen, but they don't stay there and go higher. The spikes happen and then they come down rather dramatically within a month period. That's why it's very hard to trade the VIX. Some people like to trade the VIX to go higher, but if you're long the VIX and you're kind of doing a buy and hold VIX, it doesn't make any sense, because the VIX over time will contract when events are known. So when the reason why we like to start with high IV and sell more, take a larger position size, is because we know that over the next 30 days that there's a high likelihood that the actual volatility will be much less. And vice versa. On the other side of the coin here, we target a much lower position size when we have low IV, because this says that once you have low IV, then there could be an event in the future that takes an IV of maybe, like, say 10% implied volatility to a 60% implied volatility, because a news headline or event or new product announcement or an accounting scandal, or some bad news that you didn't anticipate over the weekend. So this is why when you're down in when you have low IV, you don't want to be selling premium, number one. You want to be buying premium. But when you're buying premium, you also want to use less of your capital, because you're not anticipating, you're trying to account for any unexpected high volatility events. In the case where you're correct in the direction, that's going to make you more money, and that's good. You can still put that capital to use. But in general, this is kind of the chart here to kind of summarize without getting too crazy on you. The green side is really, again, for your 1 to 2%, target that when you have low IV strategies where you're buying premium, or when the market's just not giving you a big amount of volatility. And you can go up to your 4 or 5% position size when the market's giving you tons of implied volatility, and these typically include earnings trades, but not always. If you take on more risk, then you're going to have a much harder time recovering from those events. So for example, if you put yourself at instead of 5%, you're risking 10%, right? That means you're risking, $5,000 instead of $2,500. You're going to have a much, to make back $5,000, you're going to have a much longer time that you need to work off the number of occurrences to make up for your loss. But with a $2,500 loss, you have fewer trades to be able to make up for that one bad trade. Or a couple bad trades. So going back to our conclusion again, we talked about the 1 to 5%, why you would be on the 1 to 2 side, why you would want to be in that 3 or 4, 5%, when you would want to be in that 5% trade, why cash is very important. So stick to the high probability profit trades, stick to high IV, over 60%, you want to sell premium, under 40%, you want to buy premium. Watch your overall delta of your stock portfolio. If you're, that's something that we kind of didn't get into a lot during this video, but if you now have 8 or 10 trades and your delta is extremely negative, that means that you're expecting the overall market to go down. If you sum up all your trades and your delta is overall positive, then you'd expect the market to go up. In option trading, we typically a good strategy sometimes is to have a zero delta, which means you don't care which way the market goes. But that doesn't mean that you don't have to have a bias. If the market is trending up, then a positive delta is perfectly normal. Or if you're being a contrarian, these things are perfectly normal. But the things, I guess, to watch out for are when the delta is extremely high or extremely negative, and what you're thinking is actually different than what your option trades have on. That's when you want to just check your trades, check your delta, check your theta decay. How long will it take for that delta to achieve its goal? If you're beyond 45 days, that might be something you're comfortable with. But if you're within 30 days, then you're more at risk of a market move where the volatility, or what's called gamma risk, which is the acceleration of delta, right? Where gamma risk could actually put your trades all at risk all at once. So be careful of the gamma risk and your delta, and watch your delta for your overall portfolio. But in general, a lot of the platforms will allow you to do this automatically, and you don't have to do it by hand. You'll have an overall sense during the month of where you are with your trades. And then lastly, cash is extremely important to have as a buffer. You always need cash to be able to unwind, roll, close your strategies, because what we didn't really talk a lot about here is that if you do have an adverse event go against you, then all of a sudden, if you're margined out, you're close to your maximum cash, or you're close to being in max margin, then you're going to be in jeopardy of like a margin call where you're actually going to have to close a trade instead of waiting the 15 days for it to have a positive theta. You're going to have to close that position, and now you're going to have to come up with more cash, and you're going to take on a bigger loss. So in order to not be in trouble where you have gamma risk, you're going to have to have enough cash on hand where you might have to adjust your position so that you're not going to get in trouble. But hopefully this was a good example of the good video on position size. This is our first video on best practices, and our first and our most important video on on best practices. So I hope you enjoyed this video. Please subscribe to my channel and please comment on the video and hit the notification button. Tell me what you liked about the video. Tell me what you didn't like about the video and how I can provide a little bit more information or different articles or different videos in the future. So this video, we showed you the position size. This is the first and foremost, like I would consider, most important video for best practices, or what I call option trading pillars as well, where I'm going to have a series of videos that'll help you guys kind of form the foundation, the pillars of option trading. Position size is the first and foremost one that we covered today. Knowing how to size your trades on your portfolio is the single most important tool you can have for success. In subsequent videos, we're going to talk about understanding volatility, why it's, the X factor in option trading. It's the single most important edge that we have. We're going to talk about trade entry rules and how to be disciplined, knowing when you shouldn't chase stuff or what you should look for, high volatility trades, when to wait, be patient, how to maximize your returns, because we all do that. We all chase stocks, we all chase trades, we all take flyers, and sometimes that is to our detriment. We're going to go over the option Greeks, learning what the option Greeks are all about, why they're important to understand them. They're hard at first, they're difficult at first to grasp, but once you kind of start to have a good understanding, a visual about what they are, I'm a very visual person, so I'll show you some visual slides where we'll talk about Greeks. And once you get a handle on Greeks, it's really like anything else. It's like riding a bike. It's really easy to understand, and a lot of the platforms already kind of help you with the Greeks. And at the end of the day, it's important to learn, but it's not the single most important thing. But it's important to learn to take advantage and to be more mechanical in our trading, which always helps in option trading, because you don't want to be too emotional about your trading, because we want to follow a set of best practices and strategies, and we know over time that those strategies tend to work. If you're more mechanical, it's going to work in your favor. And then, like, different types of security selections. How do you go about, choosing securities, even with position size, or different strategies like selling premium for income versus buying premium? There's a different type of security selection that you use. Do you look at ETFs? Do you look at stocks? Do you look at low price stocks? So I get a lot of questions about people asking me whether or not they should sell or buy options and the stock price is below $10. Typically don't do that. The price itself is an option. So I say, typically, if you like a stock that's $10, then just buy it outright. My videos are not about how to get rich, quickly. It's more about giving you the tools to be successful option traders, and that's trading larger, more established firms, and you're really trying to get an edge. We're trying to get that edge of the alpha, we're trying to get that alpha edge, which is that return above and beyond what you would get in the S&P 500. And then just understanding expected moves, what every investor needs to about, like, not just your typical option trader, but even investing. If I knew about the option market a long time ago, it would have helped me understand more about the regular moves that you would expect in the market. The option chains give you a lot of insight into how to calculate expected moves, how to understanding, like, the option prices and what to look for, and then you kind of get into, again, the mechanics of what you're looking for, like, and also, like, what to expect during earnings trades. What's a good trade? If I told you that you're going to collect $1.60 on Apple for next week, is that a good number? Is that a bad number? Is that a lot? Is it a little? Is it a good trade? A lot of this is subjective, but it's also mechanical over time. you start to see over time what are the numbers that you would typically choose for buying premium on a particular strategy like call butterflies or put butterflies, and then what would be the type of money that you'd want to receive where you're selling strangles, and then what were you looking for selling credit spreads or put spreads, so that you can get a sense over time the expected moves, what to expect, and then it just becomes more second nature to you. So hopefully you guys will like all these video series that we're trying to put together here, and it'll help you in your trading. So once again, guys, I hope you enjoyed the video on position size. We talked about size, probability, buying power reduction, portfolio allocation. We went into a little bit of examples on how you can use a calculator. Please leave a comment if you want me to share the calculator with you. I can share it with you guys. Comment in the video below, and other factors associated with position size, single most important factor in option trading. Make sure you have plenty of cash. Thanks for watching. I'll see you in the next video. Have a great week. Got lots of earnings coming up next week, so take care. Have a great week. See you guys.